Oh, we're live.
We are live. Welcome everybody to another Ask Me Anything. We're going to go ahead and go around the horn here in just a moment, but please go ahead and get those comments, questions, anything else you want in the chat box, and we'll see you in about 14 seconds. All right, we're going to give it a few minutes and let everybody get into the room and get your comments and questions in there. But with that, Brian Fouts here up in North Idaho, and been very dry up here, a lot of fires. But strangely enough, at 11 something last night, the power just went off, just completely went off. Had to go start our generator, found out that it was broken, got it kind of to work. And then 10 minutes ago, power went out again. We have no idea why. Up here in the mountains, though, but now I got the generator running, so we're good to go. But it's weird. Typically it only happens in the wintertime, but now it's happening in the summertime. So a little crazy. But with that, I'll pass it over to Mr. Lenos.
Hey, everyone. Lennis Nolt here from Hopkinsville, Kentucky. Another hot day for us. We'll probably have a thunderstorm come through later today and cool us off a little bit, hopefully. But yeah, having a lot of fun helping a lot of people, and happy to be here and answer any questions I can and help along. Tess, what do you have going on?
Hey, it's Tess Hulick. I've been on the phone all day too. Love it. Please keep calling. We love helping you. If there's anything we can do, that's what we're here for. We care and we want to help you move forward. And I saw Kathleen. Hello, Kathleen. Always great to see you here. Now over to, and I'm using both hands so I don't get in trouble, Jason.
Hey, what's going on? Since we're getting weather reports around the country, I'm in Florida. You can guess what the weather's like down here. We are one of the lightning capitals of the world. So while it's sunny at the moment, that doesn't mean it will last. And man, aren't we getting good at ping-ponging the conversation around the horn? So I see we already got some cool questions. Brian is our question asker and answerer some days. And sometimes we get to answer as well. So Brian, up to you. Let's have some fun. I got a half hour with you, so let's do this.
See, we got one from John Kylan Sanford. Says, if I'm about to receive a $300,000 payout, congrats, that's awesome. Can I use that entirety as a lump sum with premiums around $1,000 per month, or would the premiums have to be much higher for that lump sum?
And you better give John Kyle a good answer, because he looks like the only person on our team that could potentially defend ourselves from someone like that is going to be Mike Samet, right? So. Yeah. So before we answer, I just want to set some context for everyone. So John, congratulations, but let's go around the horn and get some answers.
He's got more in there. Do you want to read the rest of it too?
Yeah. Is it plan on making a call with you next week when you have an off day? So that's awesome. That would be one of my first recommended steps. And then he's asking, second part, should I open up multiple policies with smaller lump sum and lower premiums? So I'll answer this first one, and then you guys answer the first question. So it doesn't matter if you do one large policy or multiple small ones. The ratios are all going to be the same. So the only reason why I might recommend more than one policy is you might be doing policies on multiple people in your household as an option. But how about this question here?
Yeah, I'll start and I'll kick it over to Linus and Tess. First, congrats, like we said a few times. Second, it depends. We have to have a conversation to see more about you. What are you trying to accomplish? It'd be like you coming into the doctor and being like, my toe hurts, and then I give you antibiotics, and you're just like, what the heck, man? You didn't take 2 seconds to get to know who I am and what happened to me and why does my toe hurt? So instead, we want to have a full conversation. Like, why would you want to get all of that capital, all of that money that you're receiving into a policy at once? Like, what's the purpose of it? Is it going to move right back out? I'm actually putting together a webinar tomorrow that's more about control and where your money's sitting. And this is for you, John Kyle, because and you got JK initials I just noticed in my head. But with that, like, I've got a couple that's got, basically $12,000 in debt that's going out, and 10 of their debts are between 16% and 31.99%. And they've always been very good financially. They're high earning individuals, so they have a lot of opportunity. And, they could go and take that money, put it into a policy, take it out, go make a return of interest on it, do what the banks are doing. But my thought for them, the way I diagnosed their problem is, okay, well, you're bleeding $12,000 a month to somebody else at a high interest. Why wouldn't you use some of that to recapture that interest before you go and do the next thing? So again, that's a lot to tell you. We need to know more about you. I'll see what kind of genius that Tess and Linus have to add to that. So,
yeah, there's certainly. Go ahead.
Oh, no, I'll let you go, Linus, because isn't that range too big for Mac?
Oh, it is. It is. Yeah. There's more to look at. Yeah, even with just looking what's happening with your income now, whether it makes sense or how much of that would it make sense to put into a policy on an ongoing, monthly or annual basis. So yeah, just a rule of thumb, the very maximum that might be possible if everything else checks out well, the very maximum spread as far as low ongoing premium and a large dump in might be about 10 times, to where the dump in is about 10 times the annual premium. So maybe 30,000 a year would work with a 300,000 dump in. Not always. So I'm just saying that that's about the maximum that could work if everything else checks out well. And of course, we got to see more.
I use 7 as the multiplier usually. Mm-hmm. And it works for any age level. That's why.
Yeah.
Depends on company though too. Because I mean,
yeah, that's the big
one company. Yeah, I mean, there's one company that you couldn't do that dumping. There's just no way they would allow it. In other companies, they would. Mm-hmm. Well, it has to be a very large premium of that other company. Yeah. So, Tess, you got any thoughts on that one?
Same. My first thought was the MEC, that it wasn't going to pass the MEC part of it. So.
Yeah.
See, you're diagnosing the math of it before you know what the problem is. Come on, Come on, folks. We don't lead with walls of numbers. Let's start with what is your problem, John?
Yeah, exactly. Yep.
Or what is your opportunity? Either or, right? You have a massive opportunity. So maybe this is even the right vehicle. Maybe like Dex is put in the thing. Maybe it's an annuity that gives you a guaranteed percentage on a percentage of this money. And then just a percentage of that money goes into a policy depending on what you're trying to do. So again, a conversation. I wouldn't wait until get on the calendar. We'll put it in the chat. Get on the calendar as soon as possible and have that conversation with one of us. So,
yeah. All right. See, another question we got here. So Dex has a good comment here. It says, I'm liking what I'm hearing about annuities. So just for those of you who are listening, maybe your first time, yeah, we do annuities, all that kind of stuff. And we just did a presentation here on Monday about annuities. Really awesome presentation, Chris and myself. So that was a good one. He's saying, upon my graduation to next life as an Eagle, can I have my death benefit go straight into an annuity and pay kiddos monthly to my kids? I don't want lump sum sent to them. Yeah, Dex, you actually can do that. So the way that would work is you'd have a trust that has that structure set up inside of it. So the death benefit would go into the trust, and the trust, instructions would be to go and purchase an annuity for whatever that amount is, and it could be a deferred annuity, could be income immediately, all that kind of stuff. But yeah, you can do that. And I actually have seen that structure, by the way, set up.
And make sure you time your. Oh, sorry.
No, that's fine.
And make sure you time your death so that the annuity rates are higher.
Yeah.
I was going to say you don't even have to, this is specific to people's situation, but you don't even have to have the trust and the annuity. The insurance company can do that directly. You can set your policies to pay out an income instead of a lump sum. So you can do that directly with the insurance company. Or if it's been set to a lump sum, the beneficiary still has the option to elect a income over a certain number of years or, something like that. So because that's what the insurance companies already specialize in, is in mortality and managing money over long periods of time. So yeah, they already have that option built in.
Yeah. The only caution I put against that is that the companies that do infinite banking very well might not be the same companies that do annuities very well. And I'm learning that right now, by the way, because we're getting quotes all the time. And every company and annuities have different bells and whistles and features and things like that. So, and then like some of the companies we work with, they can't do the certain annuities that we're doing right now. I found that out too. Some can, some can't. But that's why I kind of like the trust involved in there, because they can go get a bunch of quotes. Have you ever? So I've never seen a client take cash flow or some death benefit yet. when someone passes. I haven't had anybody that's done that yet. Have you guys?
Not yet, no.
Not yet. Not yet. And that's, someone pointed that out to me earlier. Like a lot of us, even though Tess, you've been in the industry for 30 plus years, Brian, you've been around this for a decade plus, Linus around it for a while. I'm around it for a while now, but there's still always new things to learn. And as Smiling Dog put in there, the only thing that we know for sure is that we know nothing for sure. And I believe that to an extent, other than I'm going to look back at see what history has told me. And when we look at partnerships, we say, okay, which partner has been profitable every year and why are they profitable? When we look at the different companies that we work with, they have to be mutually owned, they have to be dividend paying, they have to be whole life companies. That's all we're talking about here when it comes to that portion of things. But what is their track record? And can we predictably say, okay, we can't ever guarantee a dividend, but they've never missed in 137 years, 149 years, 121 years. So how much control and certainty does that give us, like you said, in these uncertain times? Like we don't know anything, but we know, hey, we don't know what inflation's going to be. We don't know what taxes are going to be. We don't know what annuities are going to be. Like timing the death of of yourself to have a higher rate of your annuity, like that's not going to happen. So what system and process can you put in place that you actually control?
Yep. See, any questions here? Let's see. And then John says, so he has 2 rental properties, wants to pay off those as long with some vehicles, and he makes a good amount of money per year. So we can take all your information. Your money mentor, whomever you connect with, can take all the information, load it into the vault, and map out all that for you. It's one of the things that we can do that a lot of others cannot, just being honest, is we can really use our software to map out your strategy and put actual numbers down in front of you, which is very cool, rather than just, chicken scratch on a piece of paper, which is how we all started though. And then this is something that I applaud you, because I wish, and we all wish, that more people would bring all their information, financials, goals, all that kind of stuff to the calls, because it just makes it easier for everybody involved if we have all the information on the call. But yeah, I don't know, obviously, Jason, you do that with your clients already. But yeah, so John, we'll look forward to talking with you, whoever it is.
Yeah, Brian, thanks for mentioning that. And I would agree, like people that show up, just think of your money as a tool in your life, a thing in your life. Like if you're really far away from your money, if your money's way over there and you don't talk about your money with your spouse or your family or anybody else, then there's a lot of energy around the money, and what you believe about money will be true. When you start saying, where am I at today? Like, even if it's not a good situation, like how much is coming in, how much is going out, how much do I have in a retirement account? How much do I put in savings? How much is my HSA? When you, like Brian said, when you start defining all those things and you know what's coming in, going out, you're much closer to your money, which gives us the opportunity to say, hey, here's a pattern we see, not a problem. Here's a pattern. And if you want to get to that goal, let us show you what that pattern looks like.
Yep. It's kind of interesting. So I share this story sometimes. The first time I ever met with a financial advisor, before I went into the meeting with him, I actually wrote down on a piece of paper, I said, here's what I want to get out of this meeting. And I had bullet points, and this is what I want. And I gave him when I went in there, and he was like, in 15 years, I've never had anybody actually do that.
Exactly.
And he said that, and he goes, this makes it so much easier for me. And then when I was doing a lot of financial training and education, I'd always tell my members and clients, I said, if you go to an advisor with no plan, they're going to give you their plan for you.
Yeah.
If you go there with a plan, they're going to try to make sure they can work your plan.
Yeah, yeah, amen. It's you give your money a plan, or somebody else will give your money a job. Either you give your money the job, or someone else is going to do it for you.
Yep.
Whether that's a Chipotle, whether that's your electricity bill, whether that's the school, like someone else, if you have money and you're not assigning it a job, someone else is going to give your money a job.
Yeah, absolutely.
They even say that about life in general. You either pursue your own dreams, or you're helping somebody else, which is kind of the difference between W2 and entrepreneur.
Here's a quick SWOT analysis on my life right now. I'm not sharing everything that's on there, but like that's literally tell me, what do I want? What are my intentions? What don't I want? So I can get clear on that. What are the paths I see? Who could I talk to? And what are the risks? Like just give yourself an analysis of what you're trying to solve. And if you come in like that and all your numbers, holy cow, like we'll have multiple options and a plan that you can say that one sounds good. Let's do that, and we'll show you the numbers. So.
Yeah. All right. So this is from Subaru John. It says, ladies and gentlemen, met most of you, all of you, but Tess. There you go. My adult son and his wife are about to buy a fourplex. That is awesome, man. I had opportunities years ago and I passed on them, and I wish I hadn't. So that's cool. He has a policy with Lafayette that I built for him. It's $4,800 per year, so $400 per month. That's awesome. And then he says, also on the policy, there is about $10K per year of PUA room. Interesting. So is it actually a $4,800 per month per year policy, or a $14,000 per year policy premium?
I think he probably added a rider, a raised LPUA. I think he's saying that he's an agent. Am I right? I think he's an agent that understands how to specially engineer these, and probably raised up the limit to allow for extra PUA room. Yeah,
with Lafayette, that's kind of what they do that. Yeah. So he's saying here, she is not yet insured, but they are both young, 21. Man, starting this at 21, that is amazing.
Can you imagine? Yeah. Like, Linus is young, but can you imagine?
Yeah, I can. I try not to, because it's like, oh. And he's saying that they have $150K that she got from a settlement. They wanted to put that into, and where's his other thing? A fourplex. I want to help them put it into a policy first. How can I help them accomplish that? And then he's saying also here, nope. So yeah, I mean, you guys want to take that one? So 150K coming in. They've already got a policy for $4,800 per month, per year, plus a $10K PUA room, and they're trying to get a fourplex with 150K, and he's trying to have them do the policy first. So what's the first thing he would do, or have them do? Max out the current policy.
Mm-hmm. Yeah. Max out current policy and have a conversation about the goals and what can go in it. Like, where is their money currently being assigned? Yeah. I think that's the second question.
Yeah, if it's got room for 10,000 extra a year and they haven't been maxing it out up to now, there's probably going to be room for several years of 10,000 each. So maybe there's room for 30 right now. So there is that piece. I'm guessing maybe that $4,800 a year is actually all base premium, but I don't know that.
Yeah, so if it's an all base they're putting in right now, then yeah, I definitely would want to max out the PUAs first on that policy, before doing another policy potentially. But yeah, I mean, there's different ways. If you're I don't know if you're an agent or not, but if you are, then there's different ways you could structure that policy. So like, as an example, the way I've done it for some clients before, they say, okay, I'd love to do 150K dump in a lump sum PUA, but the premium is going to be $25,000. That's a little high. So then what we do is we do two dump-ins. So one at day one, one in month 13, which reduces the premium amount. So you're not locked in for a lot of premium, but it gets you that dump-in done over 12 months instead of all at the beginning. But it's a way to get a lot of it in there. That's more on the structure side.
Mm-hmm. And there can, if the birthday timing is right, it can even make sense to backdate it to where it doesn't have to be a whole 12 or 13 months. It can be down to as little as 6 months in between the two, just depending on timing. So backdating is another thing to look at with maybe when you're splitting up the dump in like that.
Yeah. I believe Subaru John, if I'm not mistaken, you live in Alaska. Am I correct? Because that's who I think you are. Maybe you're not, but I believe that's who you are, and you are an agent. And I love that, from our first conversation to now, you're someone that just keeps pursuing. How do you teach this to your, not only execute it in your life, but now you're spreading to your family. You're going to spread it to other folks around you. And I'm guessing, so if I'm wrong, it's okay too, but I'm just saying, I think that's who you are. And by the way, I love that name. I don't know who it is, but Sugar Britches BB.
Yeah.
That's awesome. Get that paramedical done, height, weight, blood, urine, and then from there, underwriting will finish up, and we'll come back together to review your approval and talk about, hey, is this what you wanted? Do you need to make any adjustments? And let's rock and roll. Let's get it going.
You have 1 week to figure out who Sugar Britz's BB is.
There we go. Now I know.
There you go. Yeah. Thank you.
That's awesome. That's awesome. See, Roberta's another one. Congratulations, Roberta. She came in and asked her, like, I'll ask her right now. How skeptical were you of all of this? How much did you think, hey, I got to understand every single thing that happens, and what I'm going to offer all of you? No, you don't. We all know you want to, But what you really want to know is, what is the next step? What is the next thing I can do to have one of these partners say, you know what, you'd be a great partner for us. Let's go ahead and offer you this contract so you can execute your plan. Because that's, at the end of the day, all we're here to help you do is, how do you design it? How do you solve a problem? And how do you get approved? So
I love this comment by Shauna right here too. And this is in regards to the fourplex. He goes, then use it in the fourplex in, which way, like repairs, and then repay a portion of the cash flow back into the policy to recycle and capture. So it's actually kind of funny. So I've had some clients that are in real estate, and I'm getting back into it here, hopefully towards the end of this year. But if you have cash flow from properties, you take a portion of that and you put it into a policy through premiums, builds cash value, and that's your capital expense for the real estate. So you're building up your capital expense pool for repairs, vacancies, all that kind of stuff, using the actual cash flow, but you're also getting the benefit of having a revolving line of credit for the policy, death benefit, all the other things. But it's a really cool way to do that. And so I've had some clients, they're like, oh my gosh, I've been doing it the opposite of that. They've been taking a portion of the rent and putting it into just savings account or a checking account. They're like, oh my God, I could have put that back into a policy. It's like a light bulb moment right there.
Yeah, use it for your urgencies, emergencies, and opportunities. Like, just if you're going to store money, where are you storing it matters.
Yeah, absolutely.
So that's what Brian just said.
Yeah.
And the person with the fourplex, were they the one that was asking about investors? Maybe we should mention the ESP.
No, that's the Subaru John's kids and in-law, son-in-law or daughter-in-law are buying a fourplex, hopefully with their lump sum settlement they're getting. Okay. So Two Financial says Puerto Rico in the house. Awesome. So
he's also in Orlando. What's up, man?
Just closed. I think we hopefully just funded one of my first Puerto Rico policies, by the way. So
yeah, that took a minute. That took a minute, didn't it?
9 months. Only 9 months. And we had to reissue it 3 times too. So yeah, very interesting situation. But yeah. And then Sugar is saying Roberta is saying very much because I'm not very understanding a lot of the technologies. And if you're referring to the policies, yeah, that's obviously Jason's going to help you with that and stuff. And yeah, I mean, I applaud you for showing up and saying that, learning tons just from watching all of you. And for everybody else who's, on this for the first time or even second or third time, I mean, we see a lot of success on the people that we see repeatedly coming to these live streams, to our webinars, to all this kind of stuff, and even our live events or virtual events. So definitely, keep on showing up, because the more you learn, the more you can take, the more you're going to know. So I love it.
Yeah, Brian, I'm seeing one at the 49 minute mark from Sure Genius or She Are Genius. It says, I'm trying to get a company started. I'm a real estate broker and want to assist investors in purchasing homes and apartments at discounts. Do you have investors?
So definitely go to privatemoneyclub.com. That's pretty simple right there. So privatemoneyclub.com is one of Chris's portfolio businesses, and that one is a dating site for investors and money, as he calls it. So definitely go check that out. That's definitely what I'd recommend. We don't have investors per se. Like we have clients and stuff that could invest, but that's a place where you can go to and get direct access to them. So good question. Let's see here. Okay. So Kathy's asking here, do any of you know of the United States Oil Collective tokenization date coming up soon? Any info or links or info on this? I'll be honest, that's the first I've heard of that. United States Oil Collective tokenization date. So, I mean, are they creating a crypto token, like a cryptocurrency, or what are they doing? I'm not versed very much on the crypto space anymore. I used to even teach it, but I have not done that for about 7 years now. It's been a while since I've been in that space.
No, I would do is that sentence to me is, it might as well be in Spanish. Like I do not know, Kathleen, like what the answer is. I mean, we'll ask, we'll look around, we'll see if we can get you an answer on it, because I know you're part of our group. You're always here, but I don't know the answer to that.
I'm doing some searching. That USOR essentially is a token. It sounds like there's no confirmed launch date or credible information as of right now.
Okay. Yeah, I don't know. That's interesting.
I don't know anything about it either.
Yeah. So Dexter has a good comment here. This is in response to his, having an annuity be funded from the death benefit to provide cash flow to his family. And he's saying, since my family does not want to learn or practice this kind of stuff, I'll then just let them get an allowance. I'm afraid of what they'll do with the money and with their traditional mindsets. And it's a good point. And we have this conversation a lot with clients that want to get family or friends or business partners involved in infinite banking, and they just don't receive it very well. They don't want to listen. Their mindsets are obviously not in the right place, etc. So we do have those conversations with clients about the death benefits. And yeah, do you want your family to get this death benefit? Is it the best thing for them? Because there's other ways to structure it. And that's part of what we do is help educate people on that. But yeah, it's interesting.
Sorry.
But no, go ahead. It's a different subject.
I actually said, I put a little rule into place since I don't have children myself. The people that I gave mine to in beneficiaries, I said, I'll give you a higher percentage if you learn IBC. And somebody has taken me up on it.
Nice.
So I had to play the card.
I was going to offer Dex some of the, stick around. That's something that's near and dear to my heart. I know you follow what I'm doing enough to understand that I really believe in being able to write your family's vision down. And like as a father, as a leader, your family, father or mother, get that vision out of your head and then get it somewhere where it's written down. And then from there, you're going to legalize it with a trust. You're going to fund it with whole life, like you're talking about. It goes somewhere. And then living it part, Dex, is just having conversations around it. And you're going to find that some of your family will step up and they will get more curious. I'm working with a family right now where the granddaughter who's in college is like, Grandpa Joe's the best ever. He sat us down on Father's Day and made us read Becoming Your Own Banker. And I guess if he's trying to set me up, that's good. And then like his other kids won't even listen. So some, just like anything, some will, some won't. Kind of who cares, but put the systems and processes in place now and don't give yourself the story that, hey, my family's not going to get this. They're going to be spoiled. They're not listening based on that. Just how can you over time give them the experience of the conversation and what's happening? It's not going to happen now, but it doesn't mean it's not going to happen next year, 2 years, 3 years, 4 years, 5 years. Like don't limit yourself is what I'm saying to believing they can't do this and can't get it. Think how long it took you to get it, Dex.
Yeah.
Yep.
I agree.
I have something for Quantum Kathleen when we have a second.
Yeah, go for it.
Good. Yeah.
So I found a website that might be helpful for you. So it's the actual website of that United States Oil Collective thing. So it's usoc.world. I do see a countdown to August 16th, but that's on top of their site, and there's a lot of information on this site. So I'd say, I guess that's the place to start.
Yeah.
Go ahead.
No, that's fine. Yeah, interesting. I have to check that out. And then, so I'm so into numbers now. I want to teach this. I love it. Yeah, I mean, by the way, I mean that's how a lot of us got into this situation where we're at right now. Is that we learned it first, we implemented it second, we used it third, and now we teach it last. And I'll say I've learned more about infinite banking teaching it than actually, to be honest, implementing it myself. Because we're living and breathing this thing every single day, and I've been doing it for years, and still learning things. It's crazy, still learning things. So I love it.
And I came to this because I was going to prove Chris a scam. When I found out it was legitimate, I got licensed and I joined them.
There you go. So this is a good one. Hey, Creed. So is there tax advantages to owning rentals? If so, will you run me through them? Yeah, there's lots of tax benefits to owning rentals.
Not giving tax advice, not giving financial advice, but go ahead, Brian, keep going.
But, here's how I've done. When I used to have property stuff, I had a good CPA that understood real estate. That's how I did it. And I learned from that person. Now, granted, this one was one of Robert Kiyosaki's tax advisors. So it was a very high level person, but I learned a lot about it from them. But I mean, Creed, I can share my personal experience with you on our call that I think is on Friday. So, but I mean, depreciation, write-offs. I mean, there's so many ways to do it. And, I mean, I don't know, Jason, have you done real estate?
I have not.
So Linus, I know you have, of course. And I have too as well. But yeah, I mean, it's just when I had them, every expense that I had to spend on that real estate property was a deduction on my taxes. So, and then the depreciation and all that kind of stuff.
Yeah, I mean, if you talk, again, not tax advice, but if you work with, like we're working with a tax strategist right now just to make sure our businesses are set up as efficiently to protect us against risk as possible and to also keep more of our money. But part of that strategy, what I hear, from like my podcast partner Jeremy and others and Chris and others is hey, you could do cost segregation. You go in, you get a rental, and over time, that's how the wealthy. That's how Kiyosaki does it. That's why he's not paying anything. I mean, I think he owes $1.2 billion. If you look up, what he's looking at, but he's cash flowing the properties and then he's using that. But there's also, you got to measure the risk. You got to know your knowledge. You got to know this stuff and why you're doing it. But yeah, there's definitely tax advantages to owning rentals. So
yeah, yep, 100%.
But I'm done with time, but I love you all. And you guys are crushing it. So keep crushing it. I got to go do some family stuff, but I'll see all you next week. So
later, dude.
Later.
There's Steven. Steven's gone now.
I'm here. I'm hiding backstage. You guys are doing great. What's up, everyone? Yeah. What's up, Dex?
Yeah, that's a good question by Dex.
Look at that name. I love it.
Yeah, that's her cat's name, actually, by the way. Her Snow White cat. Yeah. So Dex is asking a good question here. Is there options regarding backdating season policies? For example, there's 2 larger policies I'm dealing with which are due almost at the same time. So what he's saying is you can backdate policies typically up to 6 months. So if you have a birth date while doing the underwriting of a policy, you can actually pay the prior like 3 to 6 months of premiums, and your policy will then effectively have started 6 months ago. And it's also called save age. If you're 50 years old and then you turn 51, backdating can actually have the policy being issued as if you were 50 years old, which can save you a bit on the death benefit side. But as far as a season policy, I'll let Linus or Tess answer that one.
Yeah, you can't make changes like that on a policy that's already active. I will describe for you a little bit some of the flexibilities you have. Pretty much any carrier is going to have at least 30 days of grace period. So, your latest or the latest one, you can have kind of an extra 30 days to make that premium. And the earliest one, you could pay that one early. So just kind of spreading them apart a little bit further, maybe that helps. And also, in some carriers will actually have, I believe it's the one that you're mostly with, they actually have a 60-day grace period and make even slightly more than 60 days. So, and it's as simple as calling them to find out, what is the actual lapse date, to find out how much room you have. And if you're looking at a monthly policy, say it's due each month on the 1st, or say it's due each month on the 10th, most carriers are going to allow you to have that premium draft any day of the month from the 1st to the 28th. So you kind of have that room to spread it around too, where it doesn't have to be on the due date itself. Some carriers have a little more limitation than that, but that's the general idea. So there is some flexibility like that. Let me know if I can help more on that, or just, hey, talk to the carrier.
Yeah. And then, I mean, it's not something we ever really recommend, but what's the premium account called?
At One America, it's called the PDA, Premium Deposit Account. I guess isn't another one Public Display of Affection, PDA?
Sometimes they call it advanced premium accounts. Each company a little different.
Yeah, it's just an option where you can take your premiums ahead of time, put them to that PDA account, and it earns like a 4 to 6% return on that money. That's taxable returns. And then once your premium is due, then they'll just pull it from that account. So it's a way to it's like a savings account for your premiums, essentially, that earns a return. So that's an option. But I don't think I've had anybody actually do that yet, because, I mean, you can use it somewhere else, I guess, as well. What were you going to say? You might be saying the same thing.
A lot of times when you pay your premium early, that's actually where they put it until the due date. Like it's an automatic thing. Yeah.
Yeah. What I was going to say is well, you could always just, if you have a policy loan outstanding, take that premium, pay it into your policy loan, so you're not actually incurring interest on that amount of money. So you're either saving interest or earning interest. Kind of the same thing, by the way, because it all it benefits you, by the way. So I've had people do that where they're saying, okay, I've got my next annual premium, but I don't need it for 6 months. Oh, I've got a big policy loan. Boom. They'll store that money in that account or the policy loan. And then once the policy premium is due, then they'll pull it back out again and pay the premium. But they
And
save
not
the money.
taxed on the difference.
Yeah.
Yep, there you go. So I like that option as well. Knights of Israel, haven't seen any questions from you in a while. It's awesome. So with the non-guaranteed interest, when you say they have not missed it in 100 years, does that mean they paid what they estimated, or did it at a very higher or lower sometimes? So what he's referring to is there's a guaranteed rate of return, call it 3%, 2.5%. Then you have dividends on top of that, call those 3 to 4% in some cases. What he's asking here is that non-guaranteed amount, has that fluctuated quite a bit over time? So I'll let Linus or Tess answer that one.
And the reason the amount varies is you're talking about the profitability of a company, and they can't tell you exactly how much money they're going to make. As a mutually owned company, you as a policyholder are getting a piece of the profit. They're estimating, and then it's going to be based on what the expenses are, like how much is it costing them to settle claims. And then they'll take in reserves, and that will be shared with all the policyholders. So is it going to ever be exact? No, because as much as we do a lot of planning with policies, you can't predict down to an exact number what your profit is going to be for a year, profit or loss. But they're so conservative that they do well, and they have proven themselves to do well for over 100 years.
Yeah. I was looking at one of the companies over the last 20 years. And I mean, it was less than 1% difference throughout the 20 years. So it bounced between like 5.5 to 6.5 that are over return. So, yeah. But also, you got to keep in mind, and this is really weird, the longer you have the policies, the more efficient that growth is. And it's not a linear growth. It's kind of a weird thing. Like the amount you're getting every year, let's say that nothing else changes, but like year 1 versus year 10, the percent is going to be a bit different. It's going to be more on the road. Not huge, but it does get more efficient as time goes on.
It's got to do with that uninterrupted compounding. And if you look at a compound interest chart, you always see this curve up and to the right. That's kind of the effect there. Yeah, anytime you're looking at an illustration, as far as a proposed illustration, maybe not an in-force one, but an illustration, policy illustration, that's generally going to be based on current dividend rates. And so, yes, they can go up and down, and they do go up and down. Most of the carriers we work with, or all of the carriers we work with, have actually raised their dividends in the last few years. But before that, we had been in a declining rate environment for, what was it, 40 years almost? Yeah, pretty much 40 years since the 1980s. Or wait, was it the 80s where the interest? Yeah, it would have been 30 years that we had a declining dividend rate. And that was because the entire interest rate environment and bond returns, government bond returns, had been declining ever since those super high rates in the 80s. But back in the 80s, man, dividend rates on whole life policies were in the double digits. So, everything is relative. It depends on what environment you're in.
Yeah. And I've actually seen illustrations on some of the companies that we work with that are over 20 years old. So the forecast versus what it is today, it's less than, the difference was less than 2% or something. It was, it was almost not even noticeable. Yeah. That blew me away. I was like, that is pretty cool. Can't say there's anything else.
Most of these companies, or at least the ones we work with, their actual dividends credited each year tend to be beyond what was estimated or illustrated. So that's kind of where that difference comes in, where, even if the dividend rate goes down by a little bit, it may not differ very much from the original illustration after all. I have seen my own policies, I got them, and the very first year the dividend was significantly more than what was illustrated, and I hadn't put in any extra then beyond what it was illustrated for. So that's cool. You'll see that on most. It's not any kind of promise we're making here, or it's not even really an expectation we should set, but that is what we are seeing.
Yep. All right. Let's see here. So Sugar Britches once again, and that's her cat right there, named Sugar Britches. I want to eliminate debt and be able to retire within hopefully 6 years and be able to leave a legacy, and even more so, help those in need, including homeless animals. Yeah, and I want to applaud you for that, because if you don't have a purpose in life, or a purpose for what you're doing, for a purpose for the actions you're taking, it's pointless in some cases. And so having that purpose that drives you and motivates you is awesome. And so, yeah, that's awesome right there. I love that. Thank you for sharing. Let's see here. And by the way, I did put the link in the chat box there for scheduling a call with one of our mentors. So go ahead and grab that. I'll put it in here as before we end as well. Yeah, definitely going over the numbers and down the road. Plenty of time for that. But definitely, yeah, check out the numbers. So Dex is saying, this is kind of funny. Took me one presentation from Brent. I went in with both feet. I earned while I learned. So that's a strategy right there. Took me 2 years for it to click, though. Steven's presentation, Steven Nagy, about the simple interest card example did it. Yeah, that's a pretty good example right there. I like that one. I redid mine actually on that one. All right. So Dave's asking, how do you find out if the PDA is available for your policy? I have policies with Mass Mutual. Just call up policy services with Mass Mutual and ask them. That's how.
Mm-hmm.
So I don't know
Dave.
about Mass.
See you.
Yeah.
I don't know about Mass if they have those or not. I mean, most companies, if I recall, do have those available. But just call up Mass Mutual and policy services, and they'll be able to tell you.
Yeah, and something else you should maybe look into for your policies at Mass Mutual is you go ahead and ask policy services, hey, how much extra premium can my policy or policies accept right now without becoming a mech? They'll come back to you with a quote, and if there's language in that quote you don't understand, definitely, I mean, we're here for you. And then that way oh, it's actually got room for this much extra. Hey, do I want to do that? Would it make sense maybe to do that? When somebody has an extra windfall, maybe it's good to know that there is that extra room as well. Mass Mutual is probably going to call it something different, but a premium holding account or something like that.
Yeah, something. Yeah.
Yep. So Dex is referring to the PDA account once again. Says the return is taxable. I have a few grandkids glorified savings accounts. So if I pay the premiums ahead of time, then they take that premium from the account once it's due. There is tax on what it makes before they take it out. So yeah, so the return doesn't go to the policy, it goes to you, is my understanding. So you're making money off your money and they'll send it to you, but that is considered income. So a return.
Dexter, the company you're referring to and what you have done, paying premiums ahead, you're most likely we're not earning anything taxable on that.
Yeah.
It would just be if you're paying the premium way earlier even than what you have been, that's when it would have to go into an account like that with that specific carrier.
Yep. Let's see here. Yeah, so this is so Kathleen's saying this. We have a family reunion coming up, and I want to share with all of you, my family, share us. Can you recommend an easy video pathway to have them follow? So yeah, because you don't want them to get overwhelmed. So typically what I've always just done is send clients my 60-minute video on infinite banking, 60 or 90-minute presentation.
I think the Nelson Nash book, Be Your Own Banker, is also a good tool. You're not going to be able to watch it, but that book is really good.
If they're new to this, that book is kind of technical, and it's missing some of the big things that have been developed over the last 3 decades, because it has changed quite a bit over the last 3 decades. They're a lot more involved. So if they're visual people or if they like to read, if they read, send them that book. But the 90-minute presentation, I have my own version of it that I send to clients and say, hey, send this to your relatives. And then if they get all the way through that, it's going to make a lot more sense to them because we break it down. We show examples. We show like the reasons why you want to do this. And we give scenarios and case studies. At least I do. So that's one that I would recommend. There is an introduction series that we have. I think it's a 3-video series. I can't remember how long they are, but Kathy, I can find that for you if you want and send it to you. But you have my 90-minute presentation. That's the one that I send to everybody. So.
And if something doesn't work, there's always another resource. You just keep trying till it hits. It takes a different thing for each person.
Yeah.
In a different amount of time.
This is a good question. I get this one quite a bit, actually. It says, if you have a policy loan, she's asking here, if you have a policy loan and you pay it off before the policy renewal date, which is your anniversary date, is there any interest to be paid on that loan? So.
No, generally not. Generally because at the time of payoff, you're also paying off the interest. It's billed alongside it with a payoff quote. So generally not.
Yeah, there's always going to be interest. So here's how I always explain how they calculate it. If the rate is 6%, take 6% divided by 365 days in a year. That's the daily rate. So whatever your balance of your loan is every day, they're going to just take that daily rate times that amount and then add it up. I hope that makes sense. So if you pay it off in 6 months or you pay it off in 18 months, there's going to be interest. It's just going to be less if you pay it off earlier. That's it. So it's a daily rate that they add up at. If you pay it off in one lump sum, they add it up at that point in time. If you don't pay it off before the renewal date, they'd add it up and then apply it at that point in time.
Mm-hmm. I've even learned that the hard way, where it with one carrier where it just shows your principal balance. I was like, okay, I'm done with this here. I'm about to pay it off. I just pay off the number I see on my portal, and it processes the payment. I go back to check it a week later, and it still shows a little balance there. I'm like, wait a minute. I had paid off everything it showed me. And so I'm calling, this was years ago before I was professional doing this. I'm calling the carrier. I'm like, what the heck? I mean, I had seen this number. And so I paid that off. And they were like, well, that didn't include the interest for that policy year. And so that still had to be assessed. So what I should have done, and what I would typically recommend someone that's wanting to just pay off a loan entirely, is just call the carrier and get what they call a payoff quote. Just like when you go to fully pay off any other loan, get a payoff quote, and they'll tell you, okay, this amount on this date will completely pay it off. And yeah, it is that simple.
Yeah.
Okay.
What's that?
I was just saying, because each company calculates it different. Maybe they update their individual clients' files once a week instead of once a month or every day. It just depends on how often their computer system is updating. So Linus missed it by a few days and got a little extra interest.
Yeah, if you ever go to pay off a credit card, there'll be, here's your credit card balance of $5,000. The payoff is $5,200 because the $200 is unapplied interest. It's accrued, but it hasn't been applied yet to the credit card balance. So that's why the payoff amount is higher than the actual balance of the loan, unapplied interest. But it has been accrued or earned, if you want to call it that way.
So like Linus said, that phone call is probably your safest bet.
Yep. But she's saying here, but I can reasonably pay off the interest then at the end of the year, considering what would be left on interest. Yeah. So you understand, you got it. All right. Well, that is all the questions I got there. We got about 8 more minutes. Anybody else have any other last minute questions? Otherwise, we'll let you go 8 minutes early.
Y'all, I'm just going to say something. If you are out there and you think that, oh, I can't qualify for life insurance, or, hey, I think I'm uninsurable, don't just rely on you think you are, not insurable. We've recently worked with a couple of different people who thought they were uninsurable, and we get all their details and we go check with underwriting ahead of time, and oh yeah, green flags, or we find a good carrier that gives a green flag, and we can get people approved. Not always, but you don't want to hold yourself back just because you think you are.
And even age, don't let age stop you. Many people think they don't qualify because of their age. It's always worth a phone call. We don't charge you for these calls. They're free. They're no obligation to move forward. It's worth inquiring.
Yeah. And then one question I did get here recently, what was it? Oh, it was, hey, I've got qualified funds. So qualified funds, which are called QRAs, or qualified retirement accounts, which is typically a 401k, IRA, ST IRA, solo 401k, 403, TSP. Those are all qualified accounts. And what they mean by qualified is that you don't control the money. That's what I always say is kind of funny, because those are under the purview of the IRS, and there's all the penalties and restrictions and taxes and all that kind of stuff. So can you move a qualified account money into infinite banking directly? You cannot. So that came up today on the Wealth Wednesday, and it came up on a conversation I had today. You have to receive those funds as cash first in most cases, and then move it into the policy. So usually that's going to trigger a penalty if under the age of 59 and a half, or income tax. So just got to be very aware of that kind of stuff. But the question I always ask is, well, what are you trying to accomplish? Like, what are you trying to move it into the policy for? What do you need the money for? Because if it's in a QRA, that typically is for retirement income. You need it for retirement income, because if you do, then it does not make sense to move it into the policy in some cases. Now, one of the things that we have conversations about quite a bit is that you can move a QRA account into a annuity. So that can be done, and there's no penalty, there's no taxes at that time. There's only taxes once you receive the funds from the annuity as income. But annuities are for guaranteed income, so just keep that in mind. That is something that a lot of clients are not aware of and are kind of being blown away that you can do that and get guaranteed income for life. So, and I do have clients that are using both annuities and infinite banking for different purposes, and also combined a little bit as well. So a lot of cool things.
There's even the possibility of taking a qualified plan or part of it and rolling it into a qualified long-term care plan, like we've sometimes taught about long-term care policies, and so that can be a great solution too if there's a need or a want for long-term care planning.
Yep. Oh, Dex had a question. I was going to save it for next week. All right, we'll find it. Be that way.
Mr. Believably amazing.
Yeah. So she said she has hypertension. I mean, I can't speak to how that's going to affect the underwriting. It depends on how it's treated, because people say, "Oh, I have high blood pressure." Well, what is it? 120/70. Well, you said you have high blood pressure. Well, I'm on medication. Okay, so you don't have high blood pressure. You've had high blood pressure. You don't now because you're on the medication. So a different way to phrase that, because the insurance companies are going to look and say, "Hey, if you have high blood pressure today, that's a risk. If you have a medication that reduces it, that reduces the risk." So they're looking at risk. So the question would be is, how is the hypertension being treated? And that's a conversation you can have with obviously Jason and all that kind of stuff. Yeah. So there you go. It says right there. I'm on medication.
Yep. Is it considered controlled? Yep.
Yeah. There you go. Controlled. That's what I was thinking. I was trying to think. Is it controlled? Because I couldn't get a policy earlier this year because of A1C. But I don't want to go on medication, so I went and lowered it naturally, so I don't have that diagnosis.
Yeah, good for you. That's awesome.
Dex he's had high blood pressure, medication, got qualified, no problem. There you go.
Mm-hmm.
Truck driver.
A lot of times, even borderline high blood pressure is still fine. You know, it's not like it has to be the hard line optimal range that a lab report will tell you. A lot of times they can take some risks beyond that, still without even a table rating. So it can be surprising sometimes what they can take on. Same with height and weight, like your build, because what's it called? The BMI, the body mass index. You know, they say anything over 30 is obese, right? Or is it? Yeah, I think so. And yet there's good policies approvals that can be given above 30. Of course, if there's other conditions concern, then it starts changing the picture. But build alone, unless it's really excessive, is not necessarily a roadblock either. Yeah.
What they don't like to see is someone on blood pressure, blood thinners, and cholesterol medications, and they're 5'5" and 275. Like, they're not going to like that at all. Even if you're controlled, they're not going to like that, because they know what the underlying issue is, and that has not addressed. So, but it just depends. Got a lot of truck drivers all of a sudden. So Dave's got a good question here. It says, if someone has 4 policy loans from 4 different policies, interest rates between 3 and 5.8%, total of all policy loans is about $200K, also have a HELOC at 7% with a balance of $45K, is it better to pay off the policy loans with a HELOC, or a HELOC with policy loans?
What's the rate?
Question, and it depends.
Yeah. And now, what's the rate of the HELOC?
So, David, I would just get with your money mentor and have them run your numbers through the Vault software, and that will tell you what is the best way to do it. So that would just be math on my side. I don't know if you guys have a different answer to that one. And it also depends on, are you doing velocity banking on top of all of them? Because if you're doing that, then whatever you have to use one velocity banking tool. So it can't be like all policies and the HELOC. It could just be the HELOC, which is oftentimes the easiest one to do, not the most efficient sometimes. Policy loans are more efficient as infinite banking, but they're more cumbersome to do, by the way. But it might make sense if you're doing velocity banking on the HELOC to then roll everything through that, because that's going to be a lot lower interest. It might actually be right around 4% or 3% effectively. So
something else I would mention with that comment, if you have policy loan rates at 3%, I would be willing to bet that's going to be a direct recognition policy. And so just be aware that if that's true anyway, that policy loan outstanding is lowering the amount of dividend that you get credited each year if there's a policy loan been outstanding. So that kind of maybe for you, maybe that changes the motivation maybe for eliminating that specific one. But there, I said I'm willing to bet, but I don't know this for sure. So, feel free to get in touch with us.
Yeah, that was a great catch, Linus. You're right. I didn't think about that recognition.
So John's asking a question. How did you do that? And he's referring to lower my A1C levels.
Yeah.
This is the first part of it right here. This is a glucose monitor. So it's a constant glucose monitor you put on your arm. That's the first thing I did. And then I lowered my gross carbohydrates per day to 20 to 25, which is virtually very challenging to do. And so that's what I did. But it went from like 300 down to 20. Then I went into what's called ketosis, which is where your body starts burning fat and then you're not consuming carbs and sugar, by the way. So no sugar, low carbs, all that kind of stuff. And I lost 15 pounds very quick, and my glucose went from a very high number down to like 117 within about a week. So I went down 80 points in a week. And then your A1C then slowly comes down after that. So that's how I did it. I couldn't, you can't maintain that for at least I couldn't long term because I need carbs in my diet. Otherwise I lose my balance. I get vertigo. So I'm now have carbs coming back into my life, but it's not to the level it was before. So I had to do, it's called a reset. You got to reset your whole metabolism and then go from there. But yeah, it was a lot of research, by the way, too, to find that out.
Mm-hmm.
Let me see here.
I have seen people get into a raw egg diet along with a couple other things that was supposedly able to move A1C significantly within a 2-week period, which I didn't even think it could, or what I've been told, it can't even move that quick. But he said he had some success with it, and he helped a number of people do that, even just to qualify for a policy in some cases. So I was like, okay, I'm going to write that down. I've got it here somewhere.
Yeah.
I'm not sure what this is actually saying.
That's a voice to text, so some of it.
Are you all from Day or Andrews? And what do you think is ankle on me in comparison to what you teach? I'm a truck driver. At the voice text. I usually can interpret what people are saying in voice to text, but this one I can't. I have to be honest. I'm sorry. I can't. I don't know what it is. I don't know.
What do you think is?
And then something says, how long do you have? I'm not sure what that means in reference to what. If you're talking about the A1C stuff, I mean, I really haven't checked it again. I mean, I was more because it follows your glucose levels. So my glucose went down within about a week or two. It dropped significantly. That took some time, but yeah, it was pretty quick.
Oh, after you've had your initial paramed. Okay.
After you have your initial paramed, if they tell you no go to get it right, it's 12 months.
Oh no, you can go a lot quicker than that. If they're saying you just need to get this one thing corrected, with a doctor and then maybe they may be able to reconsider as soon as that's done.
I was thinking of denial.
Yeah, and even in denial, I wouldn't say 12 months because there may be other carriers that work that can consider. It all depends. It all depends. Yeah. I mean, what you've been telling us here in this feed, I believe you're going to be approved.
There you go.
It depends. Our favorite word, it depends.
Yeah, you just got. I mean, oftentimes we'll ask, by the way, and then they'll let us know, saying, "Hey, based on this situation, we can re-look at your situation in sometimes 6 months, sometimes 90 days, sometimes 12 months. It depends on the situation." I've had people that have they got all this stuff, and they said, "Oh, if I go fix it, can I reapply right now?" And the insurance company said, "No, you got to wait. You're going to have to wait 12 months." So once again, as Linda said, it just depends on the situation. Yeah.
And then if you're in a rush, you just go to a different company.
There you go. I was going to say, go to the company. They'll know the denial. They'll ask why and all that kind of stuff, but that doesn't mean they will go and do their own math and numbers and pyramid. Yep. That's why I made the change. And it is, yeah. And by the way, I mean, it's interesting. And this is the last thing I'll say is that I've had clients that are saying, "Hey, Brian, I want to do a policy. I don't really know my numbers on my medical." And I said, "Well, you can go to your primary care and get your blood work done ahead of time so you know." And I've had people that said, "Oh my gosh, I am actually, my A1C was not where it should be. I have cancer. I didn't know that." And I lots of different scenarios. So I always recommend people, I mean, if you have any concerns about your medical, just go get a physical and get your blood work done. And man, I've had 3 clients I know of that their life was probably saved by doing that. Colon cancer stage 1, another cancer, and then something else, by the way. So yeah, definitely not a bad idea. And then, so that's, fasting, cleansing, discipline. That's what he did. Yeah. For him as well, for sure.
Unfortunately, driving commercial, so I have to use voice text. I'm sorry, I was wondering if you will compare with what Doug Andrews promotes as opposed to what you guys promote. I'll just say, we are in entirely different spheres. So we are working specifically with the infinite banking concept, which uses specially designed and engineered whole life. He's out there promoting IUL, which does not work for infinite banking. And it's really just 2 entirely different worlds of having control with whole life versus not necessarily with IUL. The insurance company has the control there. That's kind of an overview of the differences. There's so much more, but that's going to be my first.
Yeah, we do not touch IULs. They are not, I mean, keep in mind, they're not all that old. They have not been around a long time. Whole life has been around for over 150 years. Been around for a long time. IULs since popular in the early 2000s. Started in the 90s, not a proven product, volatile, etc. But I'll say one last thing on this one. I have clients from Doug Andrews that are working with us now. They had policies through him. They don't have them anymore because they were pissed. They did not perform. They had surrender charges. It did not function as infinite banking and did not perform as promised. So once again, not saying that this stuff doesn't work, but there you go. All righty. Well, thank you everybody for being here. Love all the questions. We do this every single week. So if this is your first time here, definitely come back because we will cover even more questions next week. With that, see you all next time and take care.